This is the Peer2Peer Podcast. I am your host, Greg Stahersky. Some well-known Alameda wallets have become active a few days after SBF got out on bail, and there's been quite a bit of speculation within the crypto community surrounding the transfer of funds from these wallets, which are all associated with Alameda Research. And for those of you living under a rock these last few months, Alameda Research was the trading arm and sister company of FTX, and also the personal piggy bank of SBF, as we've come to find out. So shortly after SBF was released on his $250 million bail, which we also now know is funded in part by the equity in his parents' $4 million Palo Alto mansion, the funds were transferred through a series of exchanges and mixers, one known as Fixed Float and another known as Change Now. And these are often used by hackers and exploiters to obscure transaction routes, so basically just covering their tracks. Now, some have speculated that the pattern of fund transfers could be the work of an insider trying to take what remains of these wallets, and others believe it to be SBF himself, and have certainly questioned the conditions of his bail and whether or not the guy should even have access to the internet at this point. Others have also speculated that this could be the work of a general liquidator attempting to recoup some of the customer funds, but it is still unclear who's behind the suspicious wallet movement. Now, as a side note, we know that FTX wallets were already being hacked for millions of dollars after the company filed for bankruptcy. So this could be a continuation of that process, but currently the US Department of Justice is still investigating that event, which ended up being a $352 million exploit. As one Twitter user put it, whoever this is, they're basically looking for loose change in the couch cushions. Avraham Eisenberg, who's the crypto investor with the self-prescribed highly profitable trading strategy that ended up draining Mango Market's trading platform of $110 million, was arrested Monday in Puerto Rico, according to a filing signed by Assistant U.S. Attorney Thomas Burnett. The self-described game theorist admitted his role in draining Mango Market's treasury shortly after the incident in mid-October, and may now be the first U.S. resident to face charges for his role in manipulating a DeFi trading platform. Eisenberg now faces charges of commodities fraud and commodities manipulation, according to the filing that was unsealed on Tuesday, and the charges could see punishments ranging from fines to prison time. A deposition signed by FBI Special Agent Brandon Rotz alleges Eisenberg willfully and knowingly manipulated the sale of a commodity, namely futures contracts on Mango Markets, by engaging in a scheme involving the intentional and artificial manipulation of the price of perpetual futures contracts. According to the unsealed complaint, Eisenberg manipulated the price of these perpetual contracts through Mango Market's native token, MNGO. He was able to accomplish this by first selling massive amounts of MNGO contracts to himself, thus pumping the price of those contracts up almost 1,300% in less than an hour. And with that inflated contract premium, Eisenberg then borrowed against the value of his position and withdrew essentially all of the cryptocurrency deposits on the Mango Markets platform. This netted him the $110 million, and the platform essentially became insolvent as a result of his nefarious actions. Now, one of the more fascinating parts of this story is that Eisenberg outed himself on Twitter shortly after the virtual heist, and he even offered to return most of the stolen proceeds, which isn't something we typically see in these type of exploits. He negotiated with Mango Markets and agreed to return $67 million to the DAO, which governs it, and as such, Mango DAO planned to return those funds to users who were affected by Eisenberg's attack. Now, one thing that's abundantly clear here is that the U.S. justice system is beginning to take a pretty firm stance on these types of market manipulation crimes, and the general consensus in the crypto community is that, given the severity of potential punishments for Eisenberg, this will hopefully discourage others from committing similar crimes. An anonymous Twitter user had obtained about 100,000 API keys belonging to users of the crypto trading service 3 and they published over 10,000 of them with the intention of publishing the rest, quote-unquote, randomly in the upcoming days. Now, this leak comes after a bunch of the users of 3 claimed that their API keys had been used to execute trades on a bunch of different exchanges like Binance, KuCoin, and Coinbase without their consent, and that in and of itself resulted in about $6 million in losses. Now, the worst part about this is that 3 initially attributed the losses to phishing attacks, but the data dump suggested that the credentials were actually leaked rather than phished. Now, multiple 3 users confirmed to CoinDesk that they were able to find their API keys among those that were shared by the leaker, and 3 CEO Yuri Sorokin confirmed the authenticity of the leak and requested that Binance, KuCoin, and the other supported exchanges revoke all API keys that were connected to 3 Now, I want to say something about this in particular because as a developer, there are so many things that went wrong in this particular scam or this hack that really from beginning to end, this CEO, Yuri Sorokin, he handled it probably about as badly as you possibly could have handled it. So anything from not even taking any sort of accountability for what had happened to then blaming the users for phishing attacks, and then also not having really any transparency once all of these API keys has gotten leaked, I don't really see how this could have been handled any worse than it was. And for anyone that still has funds that are on 3 you need to take those off immediately. And there's no reason why this company should still even be in business. If your OPSEC is that bad, if you have this poor of security controls and someone can just gain access to essentially a plain text JSON file that has over 100,000 API keys in it, there is no reason for this company to be in business, and there's no reason why they should be handling anyone's funds. Get your money off of this thing as soon as you possibly can because they do not deserve to have it. The Winklevoss twins crypto exchange Gemini has ended its partnership with digital currency groups, aka DCG, Genesis Global Trading, over its crypto lending product, Gemini Earn. Gemini has officially terminated the master loan agreement between its customers and Genesis and has required Genesis to return all assets outstanding in the program. The move comes after Genesis halted customer withdrawals in November and locked up Gemini Earn customers' money to the tune of around $900 million. The decision to terminate the partnership has also led to a public feud between Gemini co-founder Cameron Winklevoss and Barry Silbert, the CEO of DCG, with Winklevoss accusing DCG and Genesis of committing accounting fraud in a public letter. Now, to add insult to injury, on January 12th, the SEC decided to charge both Genesis and Gemini for the unregistered offer and sale of, as they call it, crypto asset securities through the aforementioned Gemini Earn program. The press release from the SEC stated the following, quote, "The Securities and Exchange Commission today charged Genesis Global Capital and Gemini Trust Company for the unregistered offer and sale of securities to retail investors through the Gemini Earn crypto asset lending program. Through this unregistered offering, Genesis and Gemini raised billions of dollars worth of crypto assets from hundreds of thousands of investors. Investigations into other securities law violations and into other entities and persons relating to the alleged misconduct are ongoing," end quote. It's unclear what the fallout of these charges is going to be and what it means for the multitude of other lending programs that are out there, but these charges are a pretty big step for the SEC, who has taken somewhat of a hands-off approach to providing any clear regulatory guidance for crypto lending programs thus far. Most importantly, though, there still isn't a clear path in sight for the hundreds of thousands of Gemini users who utilize this lending program in regards to how they'll end up getting their money back. So case in point, until this mess is resolved, I would advise everyone out there to exercise extreme caution in taking part in any of these yield or lending programs. And furthermore, self-custody any crypto assets that you may have on any of these platforms that you cannot afford to lose. And I think that will conclude the very first episode of the Peer2Peer Podcast. I just want to say thank you to anyone and everyone for listening. I really appreciate it. As you can tell between the duration of time between these stories, it took me quite a while to put this first episode together. But I'm hoping that as time goes on, I'll get a little bit more efficient with it and I'll be able to stay up to date. There are so many things happening in this industry. It's moving so quickly that it is really hard to keep up with. But I love talking about this stuff. I love digging into these stories, and I hope you will join me along the way. So as always, stay safe, be cautious, be smart, and don't trust, verify.